Assalamualaikum warahmatullah. Welcome back everyone. We are discussing earlier about the deposit-taking Islamic bank. We know very well that Islamic bank uses deposit fund to make murabaha or to make tawarruk, and deposit fund technically are loans that the bank obtain from the depositors. Of course, these are not interest-bearing loan, but the term and condition of this deposit is similar to a loan, whereby the depositors were guaranteed full deposit protection, and in some cases under the tawarruk deposit, for example, the deposit product is guaranteed a fixed income over the tenure of the placement. So to some extent, this is a leverage system that the Islamic bank have adopted from conventional banking, and therefore there are some complications when the Islamic bank intend to use al-bay' or intend to use sale or mudaraba or operating lease or any other traditional contract or real sector contract in their business operation. And this is why I'm here to look into this matter so that we can find some solution to it. Now the discussion is becoming a bit more technical. So some of you may have some exposure to the capital charges accorded by bank over their loan, but just bear with me. This is a very simple illustration. As we know that because bank uses deposit fund or borrowed fund to make loan, and therefore the danger of moral hazard may occur because the bank are not using their money to make loan, but they are using our money to make loan. So some kind of aggressive behavior may arise when bank make loan without thinking about the possible default, because the skin in the game is very low, and therefore in order to curb any kind of moral hazard, the regulation comes in to control this risk-taking behavior by requiring bank to hold adequate capital against any of the loan or financing they are giving out. So this is where the capital adequacy ratio is defined in the rate caption here. Capital adequacy ratio is 10.5%, and that would be the bank capital divided by risk weight asset or RWA. Right. So if you look at the case here, we have a fund or deposit funds of 100 million. So these are loanable fund that the bank borrow from the public, and the bank uses the deposit fund to make loan of the same amount, 100 million. So we assume zero reserve requirement, and we will basically put a risk profiling here of 20%. A risk weight of 20% is accorded to this loan. So this is a secured loan, meaning that a loan with collateral. So the RW or risk weight is put at a lower amount of 20%. So now the question here is, how much capital should the bank hold against this loan of 100 million? Because as we know that any loan the bank make out, there is a possible default. So the default can be 10 million, it can be 5 million, it can be a big default, let's say 50 million. Of course, it is impossible to see loan to default at full value of 100 million, but when the bank is careful, when the bank is prudent, then the likely default can be very, very low, maybe 1 million, or 500,000, but the event of default is sure to happen because we are giving this money to people, and people, they are not government. Government can print money in order to pay their debts, but not people and businesses. So there are bound to be losses, and these losses need to be absorbed when the loss occurred. So when we look at the how much capital that need to be allocated to absorb the losses, so we can use the formula of this 10% minimum capital requirement equal to capital, how much capital that is needed to support this exposure, divided by the risk weight asset RWA. So we can see that the RWA consists of the risk weight of 20% multiplied by the size of the loan of 100 million. And we can see that the minimum capital requirement of 0.105 is equal to K, which is the capital requirement to absorb the unexpected losses, divided by the 0.2 risk weight multiplied by 100 million. And we can get the minimum capital requirement of 2.1 million. So the bank needs 2.1 million in order to make 100 million worth of loan or financing. In case if there is a default of, let's say, 1 million, then the bank have enough money to absorb the 1 million because the allocated capital is 2.1 million. Right? So this will be a feasible or viable loan to be given out. However, if the loss is 3 million or 4 million, then we can see that the bank is not capable to absorb the losses, and therefore more underwriting or more precise measurement of risk need to be undertaken in order to ensure that the bank have enough capital to support the exposure, maybe to ensure that the risk weight is lowered from 20% to 10%. So this will require the borrower to put up more guarantors and collateral to reduce the risk, so that the capital requirement can be made lower, and therefore able to meaning that any impending losses, we have enough capital to absorb that losses. Okay, so we will further look into this matter by giving an example of a loan with higher risk weight. I'll see you again in the coming videos. Thank you very much. Assalamualaikum.